Have you ever wondered why some people who started with almost nothing end up owning a tiny piece of the biggest companies on the planet, while other people earning 3 times as much never buy a single share in their entire life? Here's the number that should bother you. Roughly 4 out of every 10 adults have never owned a single stock, not because they don't have the money, but because the whole thing sounds like something built for people who already understand it. And here's the twist. It's actually one of the simplest things you'll ever learn once someone strips away the jargon and shows you what's really happening underneath. Stick around, because in the next few minutes, you're going to understand exactly how this works in language that actually makes sense, without a single confusing chart or a single term left unexplained. Let's start with the question that trips up more people than it should. What is a stock, actually? Strip away every chart and every ticker symbol, and it's just this. A company decides it needs money to grow, build a new factory, hire more people, expand into a new country. Instead of borrowing that money, it sells tiny slices of ownership in itself. Each slice is a share. If you buy one, you now own a fraction of that actual business, its buildings, its products, its future profits, all of it, scaled down to the size of your one slice. Picture a coffee shop that decides to expand from one location to 50. Instead of taking out a giant loan, the owner sells 1,000 slices of the business to raise the cash. Buy one slice, and you now own 1,000th of every cup of coffee that shop sells for as long as you hold it. If the shop opens 40 more locations and profits triple, your slice is now worth roughly 3 times what you paid, because you own a piece of something genuinely bigger than it used to be. If the shop badly overexpands and half the locations close, your slice shrinks right along with it. That's genuinely all a stock is. Everything else, the charts, the news alerts, the jargon people use to sound smart at dinner, is just details layered on top of that one simple idea. So, how do you actually buy one? You need what's called a brokerage account, which is really just a specialized bank account built for buying and selling pieces of companies instead of just holding cash. You open one online, usually in about 10 minutes, link your bank account, transfer money in, and from that point on, you can buy a share the same way you'd buy anything else online. Most platforms today let you buy a fraction of a share too. So if one share of a company costs $400 and you only have 20 to invest, you can still own a small sliver of it. Someone with $50 sitting in a checking account earning almost nothing could move that same $50 into a brokerage account this evening and own a real piece of an actual business by tomorrow morning. Something that would have required a phone call to a stockbroker and a much bigger check just 20 years ago. The barrier that used to exist, needing thousands of dollars just to get started, basically doesn't exist anymore. Now here's where most beginners get stuck, and it's a real fork in the road, one that decides more about your long-term outcome than almost anything else you'll learn today. Do you buy individual stocks or something called an index fund? An individual stock means picking one company you believe in and buying a piece of just that one. If you pick well, the upside can be enormous. If you pick poorly, that one company can lose most of its value and take a big chunk of your money down with it. An index fund works completely differently. Instead of picking one company, you're buying a tiny slice of hundreds or even thousands of companies all at once in a single purchase. Picture a fruit basket instead of a single apple. If one apple in the basket goes bad, you've still got dozens of good ones. If the entire basket is just one type of apple, one bad harvest ruins everything you own. Someone who put their entire savings into one exciting company they heard about from a friend found out the hard way what happens when that one company has a terrible quarter, watching a third of their money disappear in a single afternoon. Someone holding a broad fund through that same afternoon barely noticed, because 1,000 other companies were quietly doing fine at the same time. Most people who actually build long-term wealth in the market do it through funds like this, not by picking the next big winner, because spreading it out means no single company's bad year can wreck your entire plan, and that trade-off, giving up the chance at a dramatic jackpot in exchange for never having your entire future depend on one company's decisions, is exactly the trade most ordinary people should be making. Before we talk about price movement, there's one more idea worth knowing, because it separates a good deal from a hyped one. It's called valuation, and it just means comparing what a company earns to what you're actually paying for a slice of it. Picture 2 lemonade stands charging the exact same price per cup. One sells 500 cups a day, the other sells 20. If both stands somehow had the same price tag to buy the whole business, one is obviously a much better deal than the other because you're paying the same amount for wildly different amounts of actual profit coming in. This is exactly why a company everyone is talking about isn't automatically a good investment, and a boring company nobody mentions at parties isn't automatically a bad one. A company's price can look expensive or cheap in isolation, but comparing it to how much money the business genuinely earns is what tells you whether you're paying a fair price or just paying for excitement, and that one habit alone keeps beginners from chasing hype at the exact wrong moment. Let's talk about how the price of a share actually moves, because this is the part that looks like magic and isn't. A stock's price is just the point where what buyers are willing to pay meets what sellers are willing to accept, updated constantly all day long. If more people want to buy shares of a company than sell them, the price ticks up. If more people want to sell than buy, it ticks down. That's it. There's no secret formula moving the number behind the scenes. It's the same logic as a garage sale where more people show up wanting the same lamp than there are lamps to sell, so the price creeps upward until enough buyers drop out. A company announces surprisingly strong earnings. More people suddenly want in. The price jumps within minutes. A company announces disappointing news. People rush to sell. The price drops just as fast. None of it is random. It's just a constant, live negotiation happening between millions of buyers and sellers at once, which is exactly why prices can move within seconds even though nothing about the physical business changed at all in that moment. Here's a concept that quietly protects beginners from their own worst instinct: dollar cost averaging. Instead of trying to guess the perfect moment to buy, which almost nobody actually gets right, you invest a fixed amount on a regular schedule no matter what the price is doing that day. Picture someone putting $200 into the market on the first of every month for 3 years straight. Some months the price is high, so their $200 buys fewer shares. Some months the price drops, so the same $200 buys more shares. Over time, those two effects smooth each other out, and the person never had to guess anything. They just kept showing up on schedule. Compare that to someone who waits on the sidelines for months trying to find the perfect entry point, watching the price climb the entire time they hesitate, and ends up buying later at a higher price, having earned nothing on the money that sat idle the whole time they were waiting to feel confident. It removes the single biggest reason people freeze and never start: the fear of buying at exactly the wrong moment, by making the moment irrelevant in the first place. Now, dividends, which sound complicated and are actually one of the more pleasant surprises in investing. Some companies, usually the older, more established ones, take a portion of their profits and pay it directly to shareholders just for owning the stock, on top of whatever the share price does. Picture owning a small slice of a company that pays out a little bit of cash every 3 months simply because you held on. You didn't have to sell anything or do anything at all. It just showed up. Someone holding a modest position that pays out around 3% a year might see a few $100s land in their account annually without lifting a finger, purely for being a patient owner. Reinvest those payments back into buying more shares, and you, recompounding on top of compounding, which is exactly the kind of quiet math that turns small regular habits into large numbers over enough years without you ever having to sell a single share to see the benefit. Let's talk about risk, honestly, because pretending it doesn't exist would be dishonest. Prices go down, sometimes sharply, sometimes for months at a stretch. The single biggest mistake beginners make isn't buying the wrong company. It's panicking during a drop and selling at exactly the worst moment, turning a temporary dip into a permanent loss. Picture two people holding the same investment during a rough year where it drops 25%. One panics, sells everything, and locks in the loss for good, then sits in cash trying to decide when it's safe to go back in, usually missing the recovery entirely. The other does nothing, keeps contributing on schedule, and rides it out. Historically, the market has recovered from nearly every downturn given enough time, and the person who did nothing usually ends up fine, sometimes better than fine, because they kept buying at the lower prices along the way while everyone else was too scared to. Time in the market, not perfectly timing the market, is the actual skill being tested here, and it's a skill built almost entirely out of patience rather than intelligence. So how do you actually put all of this together? Open a brokerage account, decide whether you want a broad index fund or a mix of that plus a few individual companies you genuinely understand and believe in. Pick a fixed amount you can invest on a regular schedule without stress, even if it's small. Automate it so you're not relying on willpower or good timing, since willpower is exactly the thing that runs out during the months you need it most. And then, the hardest part for most people, leave it alone. Don't check it every single day. Don't panic during the inevitable rough stretch. Someone who quietly started with $50 a month at 24, never touched it during any of the scary years, and simply let the schedule run on autopilot for decades, ends up in a completely different financial position than someone who waited for the perfect moment that never actually arrives. The entire strategy that actually works for most ordinary people isn't clever. It's boring, repeatable, and it doesn't require picking the next big winner or reading a single earnings report at 2 in the morning. It just requires showing up on schedule for years and letting the math do what the math has always done for the people patient enough to let it. The one is you.